AIG for having me here today to present the findings of my MBA in Finance final project. I'm actually a structural geologist as well as a mining engineer, just so you know, okay? So my project, where I work, Alternate Futures, we facilitate R&D in the mining industry. And one of the problems we've had is, where's money? There is no money for R&D, and exploration sits in the same bucket as R&D. So one of the ideas that came forth from my MBA final project was, let's look at alternative sources of funding. And so I ignored the traditional sources and looked at venture capital, angels and crowdfunding only, just to keep it as a manageable scope. So this diagram, the pure finance guys in the room might not like some of the things I put up because I'm not a pure finance person. But this diagram pretty nicely and simply explains the difference between defensive and aggressive investments. And if you're looking at something aggressive in the high risk, high return space, you're looking at some losses as well as some gains. And some gains can be magnificent. An example being Accel Partners that invested $12.2 million in Facebook pre-IPO and made a 630 times return on investment. Those wins have got to pay for the losers, and so there's about 50% of startups fail, and that would apply to greenfields exploration companies equally. 1 in every 100 deliver more than a 10-time reward, and they call that a 10-bagger. And that's what they're after. So everybody's been talking about tech, and every conversation I've had with venture capitalists and people in the private equity area has been about tech. It's rather myopic. Unfortunately, it's the reality. And so they're really interested in it because it's cheap, it's quick, and it's got a global scalability. So it means there's plenty of profits to be made. And they're looking at resources as something as the opposite. It's long-term, high capex, and there's a lot of risks that they can't quantify. Something that I found in my research that the investors are really interested to see, these 4 key things in any company they're going to invest in, is a capacity for growth, scalability, that's why technology is so exciting, profitability and sustainability. So what are the risks and requirements of these sources of seed finance? This diagram I actually stole from somebody else, but I put along the top there the funding rounds. So generally you've got several funding rounds before you can go to the market in an IPO or a trade sale, or if things haven't gone well, into liquidation. So you start out with your seed and Series A. This is in the Valley of Death. I'm sure you've all heard about the Valley of Death. Which is where exploration companies live, and it's where any startup lives. It's where you've got no revenue, or your revenue maybe is just beginning and you haven't quite reached break even yet. It's a pretty high risk space to be in, and really the people who will invest in you at that time are the people who buy in to your vision. So that's going to be friends, family and fools, or friends, family and fans, which I'm calling the potential customers you might get if you go through a crowdfunding portal in the future. Angels, which are usually in the tech field, are ex-entrepreneurs or already still existing entrepreneurs who've been there, done that, and they see young up-and-comers and they want to invest in them and help them. So the next stage along Series B and C is once you've reached break-even and you're starting to prove your business case. You haven't quite gotten to that point yet, but you're definitely looking good, and there's a bit less risk. And that's the point when venture capitalists will look at you. Once you reach that bold red line, that means you've proven your business case, and at that point you can actually go to market in an IPO or a trade sale, and that's when you'll start talking to the investment bankers. This table has got a lot of information in it, so just stare at it for a while. Okay, so looking at the funding rounds going from seed to Series C through to IPO, you're decreasing your risk as you mature and you're increasing the value. So when you're coming in at the early stage, this is the angels and crowdsourced equity funding, or P2P crowdfunding, which is debt. What they're looking at is either convertible debt which converts to equity later in a future funding round, or common stock. They're looking for a return around about 10 times the initial investment, which is a 10-bagger. That's what they want. What they get is more like 30%, if they're lucky. This is based on a portfolio. This isn't based on individual investments. And angels generally want to get out within 3 to 6 years, and crowdfunding could be up to 8 years. It's a nascent industry, and there's not very many examples I can give you on crowdfunding at the moment, but it is a fast-growing industry. Venture capital, they prefer preferred stock. These guys are the experts. They know what they're doing. They know all the tricks to the trade to make sure they get the most value. Unfortunately, this can be at the expense of early-stage funders, which is not fair because they've taken on the most risk. But as you can see from the actual return there, they get about 27 to 36% return on their investment of their whole portfolio. They usually have a 10-year period. So how this works with most venture capital funds is they've got 5 years to pick who they're going to invest in, and then the second 5 years period is follow-on funding. So if you come across a venture capital fund that hasn't raised a new tranche of funding and then past the 5-year date, they're probably what they call in America a zombie fund. So you need to find one that's in their first 5 years. And then once you're at the IPO stage, then you've proven your business model and you're looking at a return between 7 to 15% depending on how well you're going. This next chart is based on numbers from 1983 to 2003 and basically just explains the difference between defensive and aggressive. So you've got defensive being cash and bonds moving through property to shares. So shares around 1983 to 2003 gave you a return of 15%. I think this curve has come down considerably since 2008, probably about 5%. Some finance people in the room might want to talk about that a bit more. So, which investor is right for your organisation? Should we compare them? Venture capitalists, as I said, they don't exist in the valley of death, pretty much. They only want to know you once you're break even and you're looking like a sure thing, or there's less risk anyway. They're great to have on board from the start for a few reasons. One being that they can actually provide you with follow-on funding. It's pretty well guaranteed. And also the fact that they're investing in you, as James said, means that other people will come on board as well because they know that venture capitalists have got pretty strict due diligence requirements. They don't want to get sued by their sophisticated investors. Basically, if they do look at you, they'll take up to 6 months to do their due diligence on you. And they'll charge 15% on the total amount raised, on average. And they'll be with you for up to 10 years. If you get a VC on board with your organisation, someone from that VC firm is going to go on your board, which means a loss of control in some ways, but you're gaining an expert, which James also alluded to earlier. VCs protect their share in future funding rounds through things like anti-dilution clauses and warranties. You really need to make sure you get somebody who's experienced in venture capital term sheets when you're dealing with venture capitalists to make sure you don't lose any economic benefits and control. There's a slight issue with conflict of interest with venture capital because they have concurrent multiple fiduciary duties. And what that means is that they're representing the interests of their investors as individuals, as the management fund that's brought all the money together, and also the company that they've invested in because they're on the board. And that's a tricky space to be in. In America, they tend to exit via IPO, but statistics for Australia show that trade sales are more common, and that means basically a sale to an incumbent large organisation that's probably not innovative enough to come up with great stuff. If you can't get a VC on board, you could think about angels or an angel syndicate. And angels are getting a bit more sophisticated now. Probably 20 years ago, not so organised, but they're getting more and more organised. There is the WA Angels Association in Perth, and there's one in Sydney called the Sydney Angels. And they usually have a bit of an alliance going on with a lot of venture capital funds. So Artesian Ventures has something going on with the Sydney Angels. These guys, as I said, are ex-entrepreneurs or existing entrepreneurs who've had some great wins and they want to invest in the next great guys coming up behind them. So they can add a lot of value from that experience, from their networks and their competence. And they'll come in the valley of death. If they believe in your story. So they take up to 3 months to do their due diligence. The fees are much less, just legal costs, and they'll be out between 3 to 6 years. Often this is because of follow-on funding, probably to venture capital if you're still going well. Same issues with VC. You're going to have one on your board if it's an angel, but you will gain an expert. It's possible that that angel could be a micromanager, but if you write your term sheet really well, hopefully you can mitigate that problem. If you use convertible notes, it's a very popular form of finance when you're dealing with angels because it's actually cheaper. You don't need as many lawyers involved, and you don't have to do a valuation on your organisation because it's so iffy. The trouble with it is that you actually then end up with a liability on your balance sheet, which means technically you're trading while insolvent if you're pre-revenue. So it means then that creditor has a lot of leverage over you and your decisions and could actually force you into administration if they so desire. And follow-on funding might not be possible. If you can't get an angel or a VC, you try crowdfunding. This is a new industry which is growing incredibly fast. There's 2 types of crowdfunding. One is for cause and one is for reward. For cause, you see a lot of it, you hear a lot about it. If you want to get those bee things, you get the honey out. You can pay money and you get your bee kit. The early stage iPhones, I think, was the same thing. There's a lot of technology coming out, crowdfunded. You pay money and you get the first product. There's also crowdfunding for other causes, like raising money for charities. This talk focuses on 4 rewards. So there's 2 types. There's the equity, which is crowdsourced equity funding, and debt, which is P2P. Obviously, Westpac thinks debt's an interesting proposition, so they've already created a little subsidiary that does P2P crowdfunding. They're very similar to, well, they will be, I think, once they get their act together and they're all organised, they'll be very similar to venture capital. The portals will act like a venture capital group. But at the moment, their standards probably aren't quite as high because they're learning. Their due diligence period is probably about 3 months. Their fees are much less, about 5 to 8% of the amount raised. And they'll fund you for a period of 3 to 6 years and expect an exit, which would probably be either a trade sale or IPO. Or maybe follow-on funding with crowdfunding. Who knows? This is all a brand new thing. Usually crowdfunding only raises up to 2 million, so that's a limitation. And there's a perception of weaker investor protection, probably because there's no legislation at the moment. But there are crowdfunders operating legally under the existing Corporations Act. So I'll talk about that in a minute. If you have a crowdfunded funding base, there could be issues with the fact that your share registry is going to be huge. And there's going to be really big problems with managing the expectations of those shareholders. There's also issues because crowdfunding is seen to be something that's going to be global. So if you have differences between legislation in different countries, there could be some confusion there. Another thing is that it's got no secondary market. It's actually rather illiquid. But I am hearing about some collateralisation of these forms of funding. It's in its early days, so there's potential for there to be a secondary market later on. One of the real big downsides of anything that's done over the internet is the risk of fraud, cyber attack and money laundering. And that's where due diligence and proper vetting of investors and funded companies is going to be very important for the portals. Also, it could be a turn-off for venture capital and angels if you've started off with crowdfunding money because of the huge capitalisation table, all of the names on there. So this is a really lovely chart that I found which really excited me, which Forbes put together, showing the immense growth of crowdfunding. In 2012 to 2.7 billion was raised, and it's grown to this year to what's estimated to work up to around $35 billion funded, predominantly P2P lending. I got some information on default rates, and apparently the crowdsourced equity funding lending default rates are less than 7%, which is very good. But with equity crowdfunding, it's around 50%, which is in line with everybody's knowledge that about half of startups actually fail within the first 5 years of starting up. What's great about crowdfunding is that they can actually raise money by getting the masses inspired. If you've got a story that taps into their core values and it's a vision that they can buy into, you could actually raise a lot of money quite fast. So there isn't any legislation at the moment, but it's coming. It's expected at the end of this year in Australia. At the moment there is legislation in America. It's called the Jobs Act. And in New Zealand and Italy there is legislation. Canada, France and UK are also watching Australia. If we don't watch it, they're going to do it before us actually, because we're a bit slow. At the moment in Australia, crowdfunding portals that do exist actually work under the 2012, which is Section 708 of the Corporations Act. They can raise up to 2 million from 20 people in 12 months. And also the business services matching, which is under the Corporations Act. Another one is tax-free flow-through trusts such as the early stage venture capital limited partners, which venture capitalists use, and I do believe James referred to this earlier. So the CSEF legislation is expected towards the end of this year, and Bruce Bilson is the guy in the federal government who's overlooking it. We've got some examples. I was asked to make sure I bring some examples along today. And my list is a snapshot and in no way reflects what's out there right now because it grows by the week. So the big ones that I can think of are ASOB, so that's the Australian Small Scale Offerings Board, and they've actually just recently wound up. They don't exist anymore, but they were the first crowdfunding portal in the world using that 2012 rule. Venture Crowd is Artesian Venture Capital's little subsidiary crowdfunder, and they've got the link to Sydney Angels. Our Crowd is an Israeli-based venture capital fund subsidiary crowdfunder. So these ones are really interesting because they are run by actual venture capitalists, so their standards will be really good. They'll be quite sophisticated, really good due diligence, monitoring and mentoring processes in place. Crowdfund Up, Jack Quigley here in Perth runs this. It's a real estate focused crowdfunding portal and he's doing some pretty exciting things. Equity started in Australia and moved to New Zealand when New Zealand enacted their legislation. We've got Fat Hen in Perth that's not quite got any examples at the moment for funding. Kickstarter and Indiegogo I'm sure most of you have heard about, and they're doing some amazing things. In the mining space you've got Klondike Strike out of Canada, that's Oscar Joffre. You've got True Crowd in Texas, Venture Founders and Exploration Funder. If you want to know anything more, if this goes on the website, you can click on these links and you'll be able to go in and have a look at what's out there. So an example of a crowd-funded mining company, I found one. It took a while, but there it is, Planetary Resources. And would you believe it, they want to mine asteroids. So they raised US $1 million in 20 days in 2013. I haven't found any follow-on stories to find out whether they've found any asteroids or if they're starting to move towards mining the asteroids. But they raised the money. And that's an example of tapping into people's imagination. They managed to get the money because they tapped into the imagination of the public. And this is where I think graphene and things like lithium could tap into the imagination of the public. So the guys before me were saying, stay away from fad stuff. Well, I think actually fad stuff could be funded by crowdfunding. So I'll be a bit divergent there. So graphene, everybody has pretty much heard about the fact that some people are calling it the new oil, that it can add strength and conductivity to plastics and to cement and all sorts of things. There's also applications in 3D printing. 3D printing is exciting. And lithium with the Tesla cars and solar power battery there's all sorts of applications. All right, so all of those different funding sources have got the same process, pretty much, just to different degrees of sophistication and auditability, I suppose you'd call it. So they all start out with the selection process, and they'll be looking for something that matches their fund mandate and their risk appetite. Whether it comes to them through somebody chasing money, as a very active entrepreneur, or if they actually go out and seek it themselves. They'll basically be looking for deal breakers, so somebody who's already maybe got a criminal record or become insolvent. They'll be looking, one of the top things is they'll be looking at the management team, and I've heard this mentioned a couple of times today. They really love people with a track record. They're always looking at stuff in an emerging growth sector, and that's why I think things like graphene and lithium could come in there in the emerging growth sector if anything to do with new technology. And so they'll go through the due diligence process, and if you pass muster, then you'll go into the contracting phase, and this is when you'll see a term sheet and you'll see a capitalisation table. So the term sheet I'll talk about a little bit later, and the contracts and agreements basically sets you up for how you're going to operate with that funder on board. And then once they've handed the money over, then they're going to keep a close eye on you. They'll put someone on the board, and they'll be making sure that their exit strategy is actually going to be implemented. They want to know that they're going to get out with their money. I really love this Venn diagram, which was created by Paul Niederer. He's the founder of ASOB. And this Venn diagram looks very simple, but after you've looked at a few complicated due diligence checklists, and then you look at this Venn diagram, you realise that this Venn diagram covers everything. And every single opportunity out there has got different things you've got to do due diligence on. So this is a really nice way of making it a bit more generic. So, is it clear, convincing, compelling and credible? Who are your supporters? Who believes in you? And your team. They want to know that you've got a good balanced team that's passionate about what they're doing and they're capable and likeable. If you have those three pillars of success and they overlap in areas like relevance, which is that your pitch is relevant to your supporters, capability, that the team can actually implement that story, and credibility, meaning your team is trustworthy and credible. If you can have all of those, the overlap of those overlaps is called your business model, and that's your sweet spot. And that's what the investors want to see. So, generally speaking, a due diligence checklist is going to have things about corporate governance to make sure you've got the right systems, procedures, accountability measures, transparency in place. You've got a good team, that your business model makes sense and is believable and realistic, that you're actually financially viable, and they want to know a bit more about your products, how your operations work, and your legal matters like what jurisdiction do you operate in, what laws you have to abide by. The term sheet basically covers, it's driven by the investors because they want to protect themselves. It's an early stage investment and they know it's high risk. So that's why term sheets are driven by the investors. The only issue is that as a founder of a startup company or an exploration company, you've really got to protect your interests as well. So you really need to get somebody who knows this stuff involved. Because VCs have got all sorts of tricks up their sleeves to sneak in lower valuations, such as pre-money or post-money dilution by large employee share schemes, and complexity such as warrants. I'm almost done. Conclusions. So what I'd like to say is that early stage funding, as we all know, is high risk, high return. There's not enough money to go around for all of these projects. So it's a competitive process and you really need to build your networks to find the funding. The team is seen as extremely important, probably more important than your product or your project, and the ability to execute your strategy is crucial. I think that venture capitalists are way too conservative for greenfields, although resource capital funds has probably proven me wrong there with James's talk. Angels, I don't think there's enough angels to fund all of the exploration projects and startups that are out there. So I think crowdfunding is an opportunity, and I think if it does develop into something to the level of sophistication of a venture capital fund, then I think it's a very viable way to raise your funds. And it's great because it diversifies risk. So you've got a lot of small amounts of money coming from a lot of people all over the place, rather than one person or two people who might want to shoot you when your project's fallen over. And it's a form of democratisation of capital. So I love that because it means that your Joe Blow can invest in potentially a 10-bagger. It gives everybody the opportunity to invest in something that will give them massive returns. On the downside, also probably great losses, but so it is very early days. There's not many examples I can show you, but I hope you're inspired by the planetary resources story. That's me.
Thanks for Alex. I actually follow Planetary Resources. They do great T-shirts. Yeah, so you don't get any money back, you get a T-shirt. Any questions for Alex on these different types of investment funding? I'm quite sure which hand went up first. We'll go with you first.
Alex, who actually owns the crowdsourcing pool?
Well, it could be a couple of individuals. It could be a venture capital firm. It could be anyone. You could get cowboys and you could get great people. So you've really got to do your due diligence on the portal before you go investing through one. Yeah.
In the middle, sorry.
It just seems to me these days with all the online trading that can be done, that crowdfunding is a bit like retail equity in many ways.
It's supposed to be. When the legislation is enacted, it will be retail, not just for sophisticated.
We've got retail equity now through brokers and various...
Yeah, they have an AFSL, Australian Financial Services Licence, which crowdfunding portals have to have, although some of them can use third-party ones, so it's not theirs, it's somebody else's, which is a bit dodgy.
One from the far end here.
What's the position of the Institute of Company Directors with the Corporations Act and the issue of venture capital people on the board of these companies?
Do you know, the AICD, to my knowledge, Alan, you might want to correct me, hasn't actually published anything about this issue with concurrent fiduciary duties and the conflict of interest that creates. I haven't seen anything written about that. Have you, Alan? AICD? Have they written anything, any guidance?
I can say so. They're putting me on the hot seat.
Sorry.
I think the assumption is that directors of the board will manage their conflicts of interest appropriately through the normal governance protocols.
Yeah.
And maybe the rumours sometimes see that happens well and sometimes less well.
Yeah.
So it's just like the normal governance protocols.
Yeah. Thank you.
Do we have any more questions? Or more?
What's the driving factor for crowdfunding to become greater than the VC?
I think it's because it's tapping into a really big pool of a lot of people. And if you can, using social media, because social media's got to be a part of the whole process, and it's tapping into the young people, you know, they're all on social media, they're all interconnected, it's very global, very fast. So if you can tap into their imagination, like I said, you could actually tap into quite a large, vast pool of money that's diversified over the whole world. Eventually, once things are properly bedded down. I don't think they are yet, really. Yeah.
Still going on this, so I think before is the dinner. Yeah, we'll do one last question, and I think we'll all go to lunch.
Alex, I'd like to know your thoughts on an inverted crowdfund. By that I mean that the Gold Cup Challenge is an Integra Gold Rush where there's a fixed amount of money and it's going into technical methods.
Yeah, I call that crowdsourcing. And the research that I've been doing, there's a lot of talk about synergies between crowdsourcing and crowdfunding. And I think that that's definitely going to be a big thing in the future. I've heard a few things today about the cyclical and structural changes in what's going on in the world today, and I think crowdsourcing and crowdfunding is a structural change. There's actually a paradigm shift, in my opinion, happening that could impact on all of us in the mining sector. So it's good because it brings in people who previously probably didn't get a chance to contribute or, you know, help us to think a bit differently about how we do things. And it's good because it empowers people who previously had been maybe marginalised and not able to participate. But it could be bad because it means those of us who have work now will probably have less work later because we'll be competing with everyone all over the world. So, yeah, that's something to keep your eye on. I'm certainly watching that space. Yeah. Did I answer your question at all, or not really? Yeah, okay, thanks, Tom. I think I'm done. So thanks for your attention.
Okay,